I've given you the opportunity to read the five chapters, okay, from Riley and Brown, okay, last week. Basically, this is what we are going to um, learn during this investment subject last semester. Not last semester, last two semester. Okay, but however, I'm going to go quick, very fast, or what call it. Um, Very fast, we call it refreshment, okay, for you to be able to understand, okay, the first five chapters in Riley and Brown, okay. So the first chapter is the investment setting, okay. The investment setting, basically, the question that need to be answered: why do you invest? Okay, why do you invest? Okay, and then what is an investment? How do we measure the rate of return on investment? Okay, how do we investors measure risk, okay, related to alternative investment? Right. So what factors actually contribute to the rate of return that investors require on alternative investment? Okay. And what macroeconomics and also microeconomic factors contribute to the changes in the required rate of return for individual investment and also investment in general? Okay. Firstly, why do individuals invest? Okay, by saving money instead of spending it. Okay, individual trade off present consumption for a larger future consumption. Basically, we want to save money so that we can use it in the future. That's why we want to invest. Okay, so for example, we invest today 10,000, and and uh, and and it become 20,000. Okay, for example, 20 years in the future, right? So we have more money as compared to what we have now. Okay, so basically this is actually looking at the time value of money, right? Time value of money. So how do we measure the rate of return of on an investment? For example, if you look at one investment, okay, the pure okay rate of interest is the exchange rate between future consumption and the present consumption. Market forces determine this rate. Okay, so rate of interest, which mean that ada riba lah, okay, in other words. So it's actually looking at what is the value of money today as compared to the value of money in the future, but you are looking at the rate of interest, okay, rate of interest, and then it is actually determined by the market forces. Okay, so uh, yeah, the idea is that you look at the rate of interest, okay, as the underlying, okay, why actually the investment becoming um, bigger in the future. For example, if the rate of interest is 4%, then your future investment become $1.04. Okay, $1.04. All right. How do we measure again the rate of return on investment? People willingness to pay the difference for borrowing today and their desire to receive a surplus on their saving gives rise to an interest rate referred to as the pure time value of money, right? So people willingness to pay the differences for borrowing today and their desire to receive a surplus on their saving, okay, give rise to an interest rate referred to the pure time value of money. Because you know what we are trying to say is that, okay, one party has surplus of money, one party has deficit of money. So the deficit, okay, want to borrow money, and the surplus can want to can give money but at an interest. Okay, that's why um, it's actually referred as the pure time, okay, value of money. Okay, and then if you in the future payment will be diminished, okay, in value because of inflation. Okay, one more thing that you need to understand about inflation. So then the investor will demand an interest rate higher than the pure time value of money to also cover the expected inflation expenses. So basically, if you just manage to cover the time value of money without taking into consideration inflation, then your investment is actually I mean, your value of money is actually becoming smaller, or deteriorating in value. So that's why you need to add inflation, okay, in your required rate of return. Okay. If the future payment from the investment is not certain, okay, if it is the future payment, which means that we don't know when we depart with our money, we don't know whether the payment will be received back in the future. So it is uncertain, right? So the investor will demand an interest rate that exceeds the pure time value of money plus the inflation rate to provide a risk premium to cover the investment risk. So basically, your required rate of return must include, okay, must be bigger than the pure time value of money plus the inflation to provide a risk premium to cover the investment risk. Okay, all right. So we define an investment as a current commitment of ringgit or dollar for a period of time, okay, in order to derive future payments that will compensate for what? Okay, time the fund are committed. Okay, first we want to be compensated, okay, to be compensate for the time. Two, the expected rate of inflation. Okay, and three, the uncertainty of future flow of funds. Okay, so these are the definition of investment. A bit different from what we have covered from the two semesters. Okay, but it's actually the same. Okay, because first, investment is actually you want to could be paid on the time of the fund are committed, the expected rate of inflation, and also uncertainty of future flow of funds. Right? Now let's look how we measure the historical rates of return, HPR. Okay, holding period return, HPR. Okay, HPR is actually ending value of investment divided by beginning value of investment. So if your ending value is 2 ringgit, 220 divided by the beginning value, which is 200, so basically it's actually 1.10, right? 1.10. Okay, because 220 divided by 200. So what would be the return? Okay, so basically you take HPR minus 1. Okay, so HPY, holding period yield. Okay, holding period yield. So you have invested from 2 ringgit to 220. So basically the yield is actually 10%. So which is 1.1 minus 1 equal to 0.1. So 0.1 you multiply with 100. So it is actually 10%. Okay, that is HPY. Okay, so you can also okay, calculate the annual holding period return, which is looking at the annual HPR equal to HPR, okay, with the power of 1 over n. Okay, where n is the number of years investment is held. Okay, so basically this is a formula for if you want to get annual holding period. Okay, annual holding period yield. So for the annual holding period yield is actually annual HPY equal to annual HPR minus 1. Okay, all right, so this is how we calculate that. Okay, and then how do we actually look at this? Okay, arithmetic mean. Okay, arithmetic mean, AM. Okay, arithmetic mean is actually the summation of HPY divided by n. Okay, summation HPY divided by n. So where the summation of HPY equal to the sum of annual holding period years. Okay, the sum of annual holding period years. Okay, so then you divide by n. Okay, which is the number of years. For example, the first year is maybe 0.1 plus with second year 0.2 plus with third year 0.3. Then you divide by 3 years. Okay, divide by 3 years. The summation of everything 0.1, 0.2 plus 0.3, so you have 0.6, right? 0.6 the summation. Then you divide by 3, so you get 0.2. Okay, 0.2 for arithmetic mean. Okay, purata dia sebenarnya purata kepada HPY. Okay, what about geometric mean? So this is very what we call it, this is basic in calculating your mean, your yield. Okay, geometric mean is equal to this is pi HPR. Okay, then you have in the form of power of 1 over n. Okay, minus 1. So basically, where the pi is actually the product of annual holding period return as follows. Okay, HPR1 multiply HPR2, okay, multiply HPR3, okay, multiply HPR4 until n. Okay, so this one, okay, right? Then you have HPR and then 1 over n. Okay. Now, what is actually a portfolio of investment? Okay, this is the subject that we are actually looking for this semester. Okay, that we are studying for this semester, which is portfolio management. So basically, a portfolio of investment is the mean historical rate of return for a portfolio of investment is measured as the weightage average of the HPYs for the individual investment in the portfolio. Okay, so for example here, computation of holding period yield for a portfolio. So you have stock A, B, and C, and then you have 100,000 for stock A, 200,000 for stock B, and then 500,000 for stock C. Okay, with the beginning price when you firstly buy the stocks A, B, and C, 10, 20, and 30 ringgit. Okay, but if you multiply the beginning price with the shares, you get the beginning market value. So the total capital that you invested is 20 million here, right? When the ending price is, for example, here is 12 ringgit and then 21 ringgit and 32 ringgit. So your market ending value is 21 million and 21.9 million, right? So you calculate the HPR. Okay, HPR is 1.2. How do you do that? This is actually looking at 12 divided by 10 or 1.2 divided by 1. Okay, 1.2, this is 1.05, this is 1.1. Then HPY is 1.2 minus 1, you get 20%, 5%, and 10%, right? So this is individual HPY. Okay, and then you will do a weightage. Okay, weightage is actually basically on based on the capital that you invested for this portfolio. For example, here, okay, this is 15, 4, and 1. This is actually equivalent to 0.75, 0.2, and 0.05. Sorry, this is 0. 0. Okay, 0.05, correct. Okay, which is 5%, 20%, and then 75%. Okay, then you take this and multiply with your we call it the HPY. Then you get your weightage HPY of 0.01. This is also 0.01, and then this is 0.075. Okay, so the summation of your weightage HPY, you get 0.095. Okay, 0.095. Okay, another way you can do is 21,900,000 divided by 20 million is equal to 1.095. Okay, so and then you minus by 1, you get 0.095. So it's actually 9.5%. So your what call it weightage, what call it holding period yield for your portfolio is 9.5%. Okay, HPY for your portfolio is 9.5%. Do you understand this?
Yes.
Okay. Okay, risk is uncertainty that an investment will earn, its expected rate of returns. So probability is the likelihood of an outcome. Okay, so basically we know that sometimes the risk can differ. Okay, the cash flow of return can be different. Okay, in the future. So expected rate of return. Okay, basically we can look at the formula is how we look at the probability of return multiply with possible return, and then we have to sum it. Okay. All right. So if you look at there, okay, the formula is this is probability, this is return, okay, plus with probability to return to until n. Okay, so this is probability of return times possible return. Okay, we can write it, okay, summation of, okay, probability I R, okay, probability times return. This is I equal to 1 until n. Okay, 1 until n. So if n is 5, so we'll have 5. Okay, P1R1 plus P2R2 plus P3R3 plus P4R4 until P5R5. So this is 1 until, and this is how we write the summation of. So you need to sum this. Okay, you need to sum this. Okay, risk aversion, the assumption that most investors will choose the least risky alternative, all else being equal, and that they will not accept additional risk unless they are compensated in the form of higher return. So basically, risk aversion saying that majority of investors are risk averse. Risk averse, which means that you want to get the lower risk, okay, and you are only willing to go for a higher risk if you are being compensated for a higher return, right? Okay, so this is an example. This is a risk-free investment. Okay, risk-free investment, basically risk-free investment is, which means that if you invest in the government bond, a treasury bond, something like that, okay, this is, we call it risk-free, okay, investment. Okay, so the probability of distribution of risk-free investment like this, okay, 5%, and then you have 1. Okay, dia sebab dia probability dia probability dia tak ada, it's not that ni lah, dia tak ada risk. So basically that's why probability dia satu, dia boleh confirm dapat. Okay, confirm dapat. Okay, that's why if you look at government bond or treasury bond, for example, Malaysian government securities and whatever, we call it risk-free investment, risk-free rate. Okay, risk-free rate, right? This one is if we have what I call it probability distribution with 3 risky investment, okay, with 3 possible return. So for example, this one negative return, okay, the probability of getting it is below 0.2. This is 10% is about 0.6 something, and then for this one, which is maybe 20%, is about 0.2, the probability, right? So probability, if you have one probability, which means that is risk-free lah. Okay, but if the risk, okay, when we talk about the risk averse just now, okay, we want only, for example, if you are a risk averse, definitely you will go for the 5% just now, this one. Okay, you will go for this one because this is less risk, okay, less risk, okay, and then really secure, okay, really secure. Okay, for example, you invest in we call it the Malaysian government securities, okay, so less risk and also really secure, probability is 1, okay. But if you go for different type of investment, maybe you can get a higher return, but the probability, okay, the risk, okay, might be, okay, higher, right, the same as this. Okay, all right. This is a risky investment with 10 possible rate of return. So if we have 10, for example, okay, maybe if we have same we call it possibility, okay, then we will have 0.1, okay, for all 10 investment, then the probability will be 1. Okay, probability is actually you have to plus this and you get 1. Okay, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 plus 0.1, then you get 1. The same as this. Okay, the same as this. This is 0.7, right? This is probably 0.1, 0. Okay, maybe 0.15. This is also 0.15, so you get 1 also. Okay, right. Okay, measuring the risk of expected return or the variance. Okay, and this is the thing that you need to calculate. Okay, which is looking at the risk. Okay, we calculate the risk is looking at the probability you multiply with possible return minus expected return. Okay, so then we have to sum it. Okay, so the probability of return minus expected return, then you square. Okay, square. Okay, square. Okay, and then when you measure the risk, okay, you have to find the standard deviation. Okay, standard deviation is the square root of the variance. So with this is variance. Okay, this is variance. Then you square root, you get standard deviation. Okay, formula ni nanti we are going to use this. Okay, in the future. Okay, alright. Alright, and then for you to get the coefficient of variation CV, okay, which is a measure of relative variability that indicate risk per unit of return. So we take standard deviation of return, you divide by expected return. Okay, divide by expected return. Then when you have this, okay, this is actually this coefficient variation, you know, like this. But when you square the CV, okay, when you square the CV, okay, then you can have this, what I call it, the variance of the series. Okay, so this actually is the same thing. The same thing. Okay, you take the variance, then you square, right? So the summation from I or until n, the HPY I minus the expected HPY, okay, then you 2 over n. Okay, so this is the formula. Okay, but we will do this later on in the future. So the determinant rate of required rate of return is time value of money, expected rate of inflation, and the risk involved. Okay. Okay, the real risk of risk-free rate. Okay, the real risk-free rate, which I mentioned just now, for example, government bonds, treasury bills, and so on. So they assumes no inflation, assume no uncertainty about future cash flow. That's why you will have that. Okay, and then influenced by time preference for consumption of income and investment opportunity in the economy. So adjusting for inflation, okay, for real risk-free rate is equal to 1 plus nominal risk-free rate, okay, divided by 1 plus rate of inflation, then you minus 1. Okay. So the nominal risk free rate is dependent on condition in the capital market, expected rate of inflation. Okay. So that's the thing. Then adjusting for inflation, nominal real risk-free rate is equal to 1 plus real risk-free rate plus 1 plus expected rate of inflation minus 1. Okay. So facet fundamental of risk, basically we look at business risk, financial risk, liquidity risk, exchange rate risk, and country risk. These are the risks, okay, in any business. Okay, business risk, financial, liquidity, exchange rate risk, and also country risk. Okay, business risk is uncertainty of income flows caused by nature of firm business. Sales volatility and operating leverage determine the level of business risk. Okay, financial risk, uncertainty caused by the use of debt financing. Okay, borrowing require fixed payment which must be paid, okay, ahead of payments to stockholders. The use of debt increases uncertainty of stockholders' income and causes an increase in the stock risk premium. We also have liquidity risk. Uncertainty is introduced by the secondary market for investment, and how long will it take to convert investment into cash, and how certain is the price that will be received. Exchange rate risk, okay, basically we look at the uncertainty of return is introduced by acquiring securities denominated in a currency different from that of the investors. Okay, changes in the exchange rate affect the investor's return when converting an investment back into the home currency. And then we have the currency risk. Political risk is the uncertainty of return caused by the possibility of a major change in the political or economic environment in a country. So individuals who invest in countries that have unstable political economic system must include a country risk premium when determining the required rate of return. So the risk premium, okay, basically is combination of business risk, financial risk, liquidity risk, exchange rate risk, and also country risk. Or we call it systematic risk, systematic market risk. Okay, systematic market risk. Okay, we have unsystematic and also systematic. Systematic is the market risk. Okay, risk premium and portfolio theory. The relevant risk measure for individual asset is its co-movement with the market portfolio. Systematic risk relate to the variance of investment to the variance of the market. Okay, beta measure the systematic risk of an asset. Okay, last two semesters we have discussed about beta. Okay, how beta measures the market risk. Okay, and then fundamental risk versus systematic risk. Fundamental risk comprises business risk, financial risk, liquidity risk, exchange rate risk, and also country risk. Systematic risk refer to the portion of an individual asset total variance attributable to the variability of the total market portfolio. Okay, so this is how we draw the security market line. Okay, this is the risk-free rate just now. Okay, for example, the treasury bond rate here. Okay, Malaysian government securities and so on. Okay, this is the risk-free rate. Basically, if you invest in the government securities, you will get certain, what I call it, interest here. Okay, interest, and the risk is almost zero. Okay, the risk is almost zero. This is risk. Okay, then the risk will becoming higher. Okay, and the return will also becoming higher. So this is what we call the risk, the higher risk and higher return. Okay, so low risk, then we have average risk, then we have high risk. So we want to get higher return when our risk is higher. Okay, all right. Okay, changes in, okay, this is what I've mentioned before. Okay, movement along the curve that reflect changes of risk of the assets. Okay, higher you go here, okay, this in the security market line, you want to have a higher expected return. Okay, changes in slope of the security market line is the return, the risk premium. Okay, this is the risk premium, which is the expected return minus the nominal return of risk-free rate. Okay, yang ni okay, the slope. Okay, slope ini keturunan. Okay, so you take the slope is basically the slope of the expected return minus with the nominal return of the risk-free assets. Okay, market portfolio risk. The market risk premium for the market portfolio contain all the risky asset in the market can be computed, which is the risk portfolio for market. Okay, expected return for market minus with the nominal risk-free rate, where okay, the RP is the risk premium in the market portfolio. Okay, ERM, which is expected return of the market portfolio, and this one is the expected return of the risk-free assets. Okay. All right. Changes in the market premium, market risk premium. Okay, you will have a higher risk return, market return. Okay, you will change the original SML to a new SML. You will see that the market return becoming higher. Okay, coming higher. Right, this is if you shift, okay, the SML. For this one is the original SML, then you shift upward, okay, the new SML, then you will have a new, okay, a new, what call it, nominal risk-free asset, okay, nominal risk-free free rates, okay, nominal risk-free rate, right? All right, so this is chapter 1. We will have chapter 2, okay, which is the asset allocation, decision, individual life cycle, okay, and risk tolerance and portfolio management in chapter 2. All right. Okay, any question for chapter 1? Okay, I will be covering on chapter 2 maybe, and we try to finish chapter 5 chapters how I call it today. But because I know, okay, I want to see how many of you have read, okay, all the 5 chapters. Belum kan? Dah baca dah?
Habis lah.
Ya?